Everyone always talks about using whole life insurance to do the infinite banking concept. But what if I told you the best thing to use for infinite banking is actually the bank? That's right, you can use the bank to become your own bank, and it makes it much, much better if you do it this way. This is exactly what I do and how I actually use infinite banking for everything in my life. All my investments, any purchases that I make, all my purchases, I actually get all the money back for those purchases. On investments, I make money in two places at the same time, but I'm using the bank to do the concept. And that's just so different than what most people teach. But I'm going to show you exactly how you can do it and how it makes the infinite banking concept even better. My name is Devin Burr. If you have not subscribed to my channel, make sure to do that. Like this video and hit the bell so you get notified when I put out all these videos. Let's go ahead and jump into how using the bank is the best way to be your own bank. Let's talk about what infinite banking is. It's really simple. It is mimicking what banks do with money. So here's what banks do. Very, very simple. Banks get deposits from you, me, your neighbor, everybody. Those deposits are what they use as capital to lend to other people. They just have to pay you an interest rate to do it. So that's their control cost. Let's say they have to pay you 1%, just to make math easy. So their cost to control your money is 1%. What they do is they take the money and lend it to somebody else for more than what they're paying you. If they pay you 1% and they lend at 5%, the person that borrowed the money pays the loan back at 5%. So they're basically turning 1%, that's their control cost, into 5%. That is a 400% cash on cash return that the bank is making by using your money that you place on deposit. So that's what banks do with money. It's very smart. They're using your money, not theirs, to go make a 400% cash on cash return. And there's not a bank in the nation that makes less than 400 to 1,300% on your money. So very profitable business. We just want to mimic what they do. So infinite banking is you deposit money into a properly structured whole life insurance policy. Reason for it, guaranteed to grow, tax-free. It's protected from lawsuits and judgments in most states. So it's a safer place for money to sit, safer than anywhere else you could possibly put money, because it's guaranteed to grow and people can't touch it. So what you're going to do, again, is mimic what banks do. You're depositing money into a place where you have capital, you have liquidity. Remember, the bank is using our deposits as liquidity. You're using your deposits into your policy as liquidity in the form of cash value. There's a control cost because you're not using your money. You're borrowing against it. You're borrowing the insurance company's money. They're holding your money as collateral, which is very important because then it allows your money to keep compounding and keep growing, which is around 5 to 6% tax-free once you add in dividends. So you're basically getting a loan against your money. That's your control cost. Remember, the bank's control cost is what they pay us to hold our money. Your control cost is what you pay the insurance company for using their money. So let's say it's 5%, which is very on par. 5%, and then you take it and you lend it to someone else. You become a private lender. I do a lot of this. If you want to learn more about it, in the comments, let me know, and I can let you know how I do this. But basically, you lend it to somebody else as a private lender. Let's say you're lending at 15%. That's what I lend at. So what I've done, if I take that 15 and I feed it back to the policy, again, just like banks do, remember, they're lending our money out. That money's coming back to the bank at 5%, which is what I showed, right? So they're making a 400% cash on cash return because they had to pay us 1%. They turned that into 5%. So with a policy, You're turning 5%, that's your cost to control the insurance company's money. You go make 15, but you're also making 5 to 6 in the policy at the same time. So let's say it's 21%, 6 plus 15. You're making 21%, it cost you 5 to do it. That is a cash on cash return of 312.5%. I believe I did that math right. If I did it wrong, let me know in the comments. But you're just doing what banks do with money. You're controlling someone else's money at a cost to go make more than what it cost you. And the whole time you're doing that, your money is in the policy, guaranteed to grow tax-free. It's protected from lawsuits and judgments. And then it gets you also a death benefit. You're gonna die someday. So when you do, the more you deposited, the more you could use, and the bigger the death benefit to your family when the inevitable happens to you. So that's infinite banking. Here's the problem, is that insurance companies are not in the business of lending money. They're in the business of insurance, right? So when you borrow from a policy, it's not difficult. It's just a little clunky. Like you got to go to a whole bunch of different clicks and you got to do a bunch of stuff on their website. It's not, again, difficult. It's just clunky. Once you do it a few times, it's not, again, not difficult. It's just not smooth. And it takes a few days. So when you borrow from a policy, you'll have the funds in, let's call it 3 to 5 business days. So not a real long time, but not super, super quick like you could with a bank. So here's the solution, okay? The solution is to use the bank with infinite banking because the bank is in the business of lending money. So there's something called a cash value line of credit. This is incredible. This is something that the bank will do. They'll take your cash value because it's a guaranteed asset. They know it's going to keep going up in value. So they'll take that cash value and they'll collateralize it and give you a line of credit. So now you no longer use the life insurance policy to do infinite banking, to borrow the money, the control cost. Because again, banks are in the business of doing this. Life insurance companies aren't. Banks aren't clunky when you go to borrow money. With a cash value line of credit, you use your cash value as the collateral to get the line of credit. And then on the cash value line of credit, you get a checkbook. So you can just write a check directly from that line of credit. You can do wire transfers directly from that line of credit. So it's a lot easier than using a policy. Cool thing about it too is it makes it to where you can actually have access to more capital. So check this out. When you have a policy, you can borrow the cash value at any time. Okay, so you've got cash value inside of a policy. You can use that anytime you want to go do the infinite banking concept. That's the cash value. That's what you can use. However, you also have a surrender value, which is always higher than the cash value. So with a cash value line of credit, the bank will actually give you 95% access to your surrender value, which is going to be higher than if you had the 100% cash value out of your policy. So you actually have access to more money using the cash value line of credit, okay? With a policy, you can use all your cash value. With a cash value line of credit, you can borrow up to 95% of your surrender value. It's a beautiful thing. So you have access to more capital. Also, with the cash value line of credit, you've got a centralized point. So think about this, guys. I have 15 whole life insurance policies, 15 of these. When I got to about 7, it became a logistic nightmare doing the infinite banking concept because I'm borrowing from this policy. I got to repay that policy loan with interest because if I was going to pay the bank interest, I might as well pay my bank interest. I borrow from this policy. I got to pay that one back. I take a loan from this one. I take a loan from that one. I pay that one back. I pay this one back. I got to pay that one back too. Let me take another loan from this one. Do you see how it can just be a nightmare? And again, a little clunky as you're doing it. With the cash value line of credit, you can bundle all your policies, all the cash value into one. So now, instead of 15 different policies that I am borrowing from, and I just realized I put policy, not policies. So 15 policies. Now I'm just borrowing from one cash value line of credit instead of 15 policies. So one centralized point with a checkbook, with the ability to wire, so I can have funds move extremely fast. And it's just one centralized place. It's so much easier to do the infinite banking concept. And I have access to more capital because I have access to 95% of my surrender value instead of having access to my cash value. And here's the last thing that's super important. When you do the infinite banking concept, the only downfall, and this is actually a good thing, but it's also a downfall, is with a policy loan, you never have to repay it because the insurance company is guaranteeing you two things. They're guaranteeing you that they will pay you a certain percentage of growth every single year. So they're guaranteeing that the money is going to grow at this amount every year without fail. They're also guaranteeing your family a death benefit when you pass away. So since they're guaranteeing that death benefit, you don't ever have to repay loans. Because think about this, if you have a $5 million death benefit, that's your death benefit. Let's say throughout your life, you use $1 million of the cash value and you never pay that cash value back. What's going to happen when you pass away, your family will only get $4 million because you used $1 million of the death benefit while you're alive. That's what the cash value is. It's equity in the death benefit, what you can use of it while you're alive. So you never have to pay it back because the insurance company knows you're gonna die. They just don't know when. So when you pass away, if you never paid the policy loans back, they'll just deduct that amount from your death benefit. So you never have to pay it. But that actually makes the infinite banking concept not as good. Think about this. What makes this good is the fact that you're paying this 15% back to the policy. You don't have to, but if you do that, you're getting more money into a place that's guaranteed to compound and grow. You're getting more money into a place that is protected from lawsuits and judgments. You don't have to do it, but if you do it, it's so much more powerful. And here's the benefit to the cash value line of credit is with the bank, you have to make a payment. With a policy, you don't have to. So with a cash value line of credit, it forces you to be an honest banker. It forces you to have to put this 15% back into the policy or back into the line of credit. So what I do is I make payments all the time towards my line of credit. I treat it as a place where everything flows. All my income flows to paying back the line of credit. And I build up liquidity in the line of credit so I can use it again. I pay it back in, builds up, I use it again. So with the cash value line of credit, you have to make one payment per quarter, and you can do interest only. What I do is I make principal only payments. So what that does, whenever I'm making principal only payments, it's lowering down the balance, and it's a simple interest loan, meaning the lower the balance, the lower the interest that's accruing every day. So when I have to make that quarterly payment because I made so many principal only payments, when I have to make that quarterly interest only payment, it's much, much smaller because I'm always feeding money back to the system. hopefully this makes sense for you guys. This is a way to turbocharge infinite banking. If you have policies, especially if you have multiple, it makes all the sense in the world to bundle them together into a cash value line of credit and then use that to do infinite banking. Don't use your policies anymore. Whenever you have a policy premium, pay it, because then what happens is your surrender value goes up, and all you got to do is send that new surrender value to the bank that has the cash value line of credit, and they bump your line of credit. So that's the only thing you have to do with the bank, or I'm sorry, with the policy from then on. Then you just use the line of credit to practice infinite banking. It's faster, it's easier, you have access to more capital, and it keeps you honest to where you're paying back in to the concept. You're doing the actual concept. If you borrow from a policy and you lend it out for 15%, but then you don't take that 15% and funnel it back to the policy, you're not really doing the concept of infinite banking. This is the part right here. This part is what most people miss with the concept. So having the cash value line of credit forces you to do that step. That is a very, very good thing. So guys, I would love for all of you that have a policy to reach out in the comments and let me know if you'd like to get linked up with the bank that I use. I make nothing off of doing this. I don't have any kind of incentive with the bank. I just use it, and when I use something that simplifies my life, I feel like it's my duty to share it with you guys so it can simplify your life. So if you have a policy, please in the comments, let me know, and I will link you up with my guy at the bank so you can get a cash value line of credit. If you have multiple policies, even if you don't, if you have one policy, it still makes sense because you have access to more capital, it forces you to be an honest banker, and it's just easier. You can write a check, you can do wires, you're doing, you're lending money and doing that with a company that is designed for that, instead of a life insurance company that's not made for lending money. Hopefully that makes sense. So guys, if you don't have a policy, you need to start practicing infinite banking, and my team would love to help you. So in the description of this video, you'll see that you can register for my free training, watch that till the end, write down your questions, and you can schedule a call with me and my team. We'll help you get a policy set up, and then if you want, I can help connect you with my guy at the bank so you can use a cash value line of credit instead of having to use your policy. So hopefully you guys got a ton of value from this video. If you did, smash that like button. Make sure to do that. The algorithm loves it. And if you liked this video, you're gonna love that one. Check that one out next. Until next time, I love all you guys. Peace.